Welcome to the deep dive. So, if you're like most people trying to get a handle on a company's finances, you probably spend all your time on two documents.
The income statement and the balance sheet.
Exactly. You're looking for profits, tallying up the assets, looking at the debt. But there's this third document, the statement of cash flows, that often gets ignored.
It really does. It's treated like homework. But analysts, well, we sometimes call it the truth serum.
The truth serum. I like that.
Yeah, because a company can, play with its earnings numbers or asset valuations, but cash is cash. The statement of cash flows, the SCF, it doesn't lie about what's actually in the bank.
So that's our focus today. We want to reposition the SCF not as some boring accounting document, but as the critical storyteller of a company's real health. It's the bridge.
The bridge between accounting profit and actual money.
Right. And our mission here is really twofold. First, we need to get the mechanics down. How do these three big statements actually connect? And then the fun part. We're going to use the SCF's pattern of inflows and outflows to instantly diagnose a company's life stage.
From a risky startup all the way to a dominant cash cow.
Exactly.
And, if you've ever looked at a company and wondered, their cash balance changed by millions, why? The income statement won't tell you the whole story.
No.
The SCF is the roadmap. It answers that one fundamental question. How did the company go from its cash balance at the start of the year to the cash balance at the end? It's all there.
Okay, so let's start with that bridge concept. What's the biggest hurdle people face when they first try to understand this?
It's the conflict between accrual accounting and, cash. Remember, under GAAP, the standard accounting rules companies report net income when they earn it, not when the money comes in.
Right, so I could deliver a huge service in December, report massive revenue, and look super profitable. But if my client doesn't pay me until January, my bank account is still empty.
That's the exact problem. And that's why the first section of the SCF, operating activities, it starts with net income, that accrual number, and then its whole job is to convert it back to cash.
Through these accrual adjustments.
Exactly. We have to reverse all the non-cash stuff to get to the real cash flow from the business.
Okay, make that concrete for us. Let's say a company's accounts receivable, the money customers owe them, goes up. What does that do to our cash flow calculation?
Well, if accounts receivable went up, it means you recorded a bunch of sales and net income, but you haven't actually collected the cash yet.
So you have to subtract that increase.
You got it. You subtract it from net income because the cash isn't in your pocket. And it works the other way, too. If your accounts payable, what you owe, suppliers, goes up.
That means you held on to your cash instead of paying your bills.
Right. So you add that increase back to net income. You're just tracing where the cash actually went or didn't go.
So if I see inventory piling up on the balance sheet, I know cash went out the door to buy it, but it hasn't been expensed yet. So I subtract that increase to reflect the cash leaving.
You've completely nailed the logic. And once you do all of that, you get to the most important number on the whole statement. Net cash provided by operating activities.
The core business actually spits out.
That's the one.
Okay, that makes sense. Now let's connect the other parts of the SCF to the balance sheet. This is where the organizational genius really comes in.
It really is elegant. The three sections, they tell you where cash came from and where it went.
So operating activities.
That's your day-to-day business. It explains the changes in your current assets and current liabilities. Your working capital.
And investing activities.
That's all about long-term assets. Buying a new factory. That's a cash outflow. Selling off an old building. Cash inflow. Simple as that.
And the last one? Financing activities.
That's how you deal with your capital providers. So long-term liabilities and equity. Issuing stock or taking on debt is cash in.
And paying back a loan or buying back your own stock is cash out.
Or paying dividends. That's a big one. Cash out to your shareholders.
So you see the whole cycle. You start with the balance sheet. The income statement tells the story for the year. The SCF translates that story into cash. And the final number on the SCF, the net change in cash.
It has to perfectly match the change in the cash account on your balance sheet from the beginning to the end of the year. It all ties together.
It's a closed loop, which means we can use it as a diagnostic tool.
A very powerful one. Just by looking at the plus and minus signs in those three sections, operating, investing, financing, you can tell almost instantly where a company is in its life cycle.
This is where we get to be financial detectives.
Yeah.
Before we jump into the stages, what are the three big rules of thumb here?
Rule one, and this is the most important, operating cash flow is king. If that number isn't positive or on a clear path to becoming positive, the company can't survive on its own. It's the ultimate measure of self-sufficiency.
Okay, operating cash flow is king. What's rule 2?
Rule 2. Investing cash flow tells you about ambition or desperation. A negative number is usually good. It means you're investing in the future, buying assets.
But a big positive number is a problem.
A huge red flag. It means you're selling off core assets to raise cash. That's a sign of decline.
And rule 3.
Financing cash flow reveals dependency. If it's consistently positive, you're relying on outsiders, banks, or new shareholders to fund you. If it's negative, you're self-sufficient. You're paying people back.
I love that. Okay, let's apply these rules. Let's start with a classic startup or high-growth company. Think of, I don't know, a biotech firm or Amazon in the early days. What's their pattern?
Their pattern is very clear. Operating is negative, investing is negative, and financing is positive.
So they're burning cash on operations.
Right, spending heavily on R&D and marketing. They're burning cash on investing by, building data centers or factories. And all that cash burn has to be funded by
Outside money, issuing stock, or taking on debt.
that positive financing number. It's the signature of a company fueled by ambition and external hope.
Okay, now let's say they make it. They mature into a steady-state company. Established, stable, not growing like crazy anymore.
The whole pattern flips. Now it's operating is positive, investing is negative, and financing is slightly negative or neutral.
The key is that positive operating cash flow.
Absolutely. The core business is finally funding itself. They're still investing, but mostly just to maintain what they have. And because they're self-sufficient, they can start to, pay down a little debt or pay a small dividend. That's the pattern of stability.
And finally, the holy grail.
The cash cow company. Coca-Cola. Microsoft in its heyday.
The profile everyone wants. Strongly positive operating cash flow, neutral or slightly negative investing, and strongly negative financing cash flow.
They're just generating enormous amounts of cash.
More than they know what to do with, so they can't reinvest it all profitably. The only thing left to do is give it back to the owners.
Through huge dividends and stock buybacks, which creates that big negative financing number.
That's a brilliant framework. So here's the test. What if you see a mature company, say a big retailer that's been around for decades, but it suddenly shows the startup pattern? Negative operating cash, positive financing cash?
You run. Seriously, you walk away. It means their business model is broken. They aren't growing, they're just bleeding. And they're staying alive only by desperately borrowing more money or diluting their shareholders. That pattern in a mature company is a sign of deep distress.
Got it. Okay. Beyond those 3 main sections, you often see notes about non-cash investing and financing activities. What are those?
These are really important details that are tucked away in the footnotes. Remember, the SCF only tracks cash. But what if a company makes a huge move without any cash changing hands?
Like what? What's a classic example?
The most common one is buying a big asset by taking on debt directly from the seller. Say you buy a $10 million building, but instead of paying cash, you give the seller a $10 million IOU.
A note payable.
Right. No cash moved, so it's not on the main statement, but your assets and liabilities just ballooned. It has to be disclosed in the notes so investors see the full picture.
So you really have to read the footnotes to understand the full strategy.
You have to.
Okay, let's pivot to an analyst's favorite metric. Free cash flow, FCF. It's not an official JAP number, but investors are obsessed with it. Why?
Because FCF is arguably the purest measure of a company's financial flexibility. It's the cash that's truly free for them to use however they want after they've paid for the basic costs of staying in business.
So you start with that big number, net cash from operating activities.
Correct. And from that, you just subtract your capital expenditures, your CapEx. That's the money you had to spend just to maintain or replace your existing assets.
So FCF equals operating cash flow minus CapEx. What does that final number tell you?
It tells you your capacity. Your capacity to pay dividends, to buy back stock, to pay down debt, or to fund some amazing new project, all without having to go ask outsiders for money. It's the ultimate sign of financial independence.
But, and this is fascinating, high free cash flow can create a problem, the so-called agency problem.
Yes, and the classic story here is RJR Nabisco. It creates this huge conflict between what managers want and what shareholders want.
Shareholders see all this extra cash and they say,
Give it back to me, unless you can find a really profitable way to reinvest it.
but the managers might want to spend it on, what, building a bigger empire.
Exactly, empire building, corporate jets, fancy headquarters, pet projects that don't make much money. It's a huge source of waste.
And RJR Nabisco was just squandering billions in free cash flow.
They were the poster child. It wasn't until outside investors came in and pointed out all that waste that people realized the true value of the business was being hidden.
And eliminating that waste is what caused the buyout price to jump so dramatically.
From $72 to over $100 a share. That difference was the price of managerial inefficiency. The lesson is, investors watch FCF like a hawk to see if management is being a good steward of their cash.
That's a powerful story. Okay, let's wrap this up with a quick review of the most common classification mistakes. Getting these wrong can wreck your whole analysis.
Absolutely. And remember, the sequence in the U.S. is always operating, then investing, then financing.
All right, rapid fire. A company takes out a new bank loan. Where does that cash inflow go?
That's financing. Cash from creditors.
The company buys back its own stock.
Also financing. A cash outflow to the equity side of the balance sheet.
Okay, the tricky one. Paying interest on debt or receiving dividends from an investment you own. Where do those go under U.S. GAAP?
This is the one everyone gets wrong. They are both classified as operating activities. It's just a rule you have to memorize.
And finally, selling a big piece of land you weren't using.
That's cash in from investing. It's a long-term asset. Doesn't matter if made a profit or a loss, the cash goes in the investing section.
Perfect. So with these rules, you really have the framework to diagnose the health and maturity of pretty much any company.
You really do.
You can see past the accounting profit to the real cash, and you can spot a risky startup, a stable player, or a cash-spearing machine just by looking at 3 simple plus or minus signs.
Which brings us to a final provocative thought. We know that cash cow generates huge free cash flow and uses it to reward shareholders, which is why it has that strong negative financing cash flow.
Right.
So if the big danger is that RJR Nabisco agency problem managers wasting that cash, is a sustained, strongly negative financing cash flow the single most reliable proof we have? Is it undeniable evidence that management is resisting that temptation to empire build and is actually acting as a true steward of shareholder capital? Something to think about.